Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at BlackBerry.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
Okay, so BlackBerry. I think a lot of people still hear that name and, they think of the old phones with the keyboards.
They do, and that's really the core of the story here. The company we're looking at today is fundamentally different. The transformation is, for all intents and purposes, complete.
So they're a pure software company now.
Pure play software company, yeah.
Yeah.
And it's really concentrated in two very specific high-margin areas.
Right, so you have the IoT side, the Internet of Things, which is all about QNX.
Exactly. That's their embedded operating system. Think car dashboards, medical equipment, industrial robots, mission-critical stuff.
And then the other side of the coin.
That's secure communications. So cybersecurity, endpoint management, all geared towards governments and big regulated companies.
The kind of customers that value security above all else.
Precisely. And the big question for years has been, can this pivot actually make money? And I think the latest quarter finally gave us an answer.
Okay, so let's talk about those numbers. Q3 fiscal 26.
Right. So total revenue was $141.8 million, which, beat their guidance. That's nice.
But that's not the headline, is it?
No, not at all. The real story, the validation of this entire long, painful shift, is that they actually swung to profitability.
And we need to be really clear here. We're not talking about some adjusted metric.
No, this is the real deal. Positive GAAP net income.
$13.7 million.
Exactly. And GAAP generally accepted accounting principles. That means after you count everything, all the real costs, they are structurally making money.
That feels like the inflection point everyone's been waiting for.
It is. It shows that the shift to this high-quality, recurring software revenue is working. It's margin accretive. Their adjusted operating margin hit 18%.
18%. For a company in transition, that's pretty strong.
It's very strong. And it sets up this really interesting dynamic for the future. You see analysts projecting maybe 6% revenue growth per year.
Which sounds, okay, not amazing.
Right. But then you look at the earnings growth projections.
Yeah.
And those are closer to 30% a year.
Whoa. Okay, so how does that work? 6% on the top line, 30% on the bottom line.
That right there is the definition of operating leverage. It means their cost base is now relatively fixed. So every new dollar of high-margin software revenue doesn't cost much to deliver.
It just drops straight to the bottom line.
It drops disproportionately to the bottom line, yeah. The heavy lifting on costs is done.
Okay, so a good growth story needs a solid foundation. Let's talk about the balance sheet. Are they, running on fumes?
Quite the opposite, actually.
Yeah.
And this is a huge comfort factor. They're sitting on $378 million in cash and investments.
And they're generating cash now, too.
Yes. Positive operating cash flow of $17.9 million in the quarter. So that pile of cash is growing from the business itself, not from, selling things off or taking on debt.
Which means they're not going to need to go back to the market and dilute shareholders.
It eliminates that near-term liquidity stress completely. It gives management what we call optionality. They have breathing room.
So what are they doing with that cash? Dividends? Buybacks?
Not right now, no. The priority is all about reinvesting in the business.
Plowing it back into QNX and secure communications.
Right. And maybe some small targeted M&A. They're building a war chest to buy future tech or market share, not to turn capital just yet.
So for an investor, what's the takeaway here? You've got this software company. It's now profitable on a GAAP basis, generating cash, and it's trading under $5.
It's what you'd call embedded optionality.
Meaning the price still reflects the trauma of the past few years.
Exactly. The market hasn't caught up to the new reality. So any piece of good news, a new design win, an upsell, it could have an outsized impact because the downside risk is so much more limited now.
It's like a compressed spring.
It really is. The hard work is done, and now you're just waiting for the growth to flow through.
All right, so let's dig into that growth engine. QNX, it just hit a record revenue number, right?
Our record, yeah. $68.7 million, up 10% year over year. And the key here is understanding why that business is so durable, why it has such a strong moat.
It's all about the certifications, isn't it?
100%. QNX is a safety-certified real-time operating system.
Yeah.
It's used in things that absolutely cannot be allowed to fail.
Like a car's braking system.
Or a medical infusion pump, or a factory safety controller. To get into those systems, your software has to pass incredibly strict global safety standards.
And that process is not easy.
It's astronomically expensive and can take years. So once a manufacturer, like say a car company, designs QNX into their new EV platform and gets it certified,
They are not going to rip it out. The switching costs are massive.
massive. So one design win turns into a high-margin royalty stream for 7, maybe 10 years. For the entire life of that product line, it's incredibly sticky revenue.
And they're not just sitting back. I saw something about the QNX Everywhere initiative. That seems really smart.
It's kind of genius, honestly. It's a long-term play. They're giving out thousands of free licenses to university students.
Over 12,000 licenses and 80 agreements with Indian universities, I think.
Yeah, engaging something like 6,000 students. So you have the next generation of engineers learning to build robotics, race cars, complex systems, all using QNX as their default tool.
So by the time they get a job,
They're already fluent in the platform. They're
Yeah.
going to specify what they know. It's building an ecosystem moat, just like we've seen with other specialized software tools.
okay, so QNX is the growth story. What about the other half? Secure communications. That seems to be the steady cash cow paying for all this.
That's the perfect way to put it. It's the resilient anchor. It brought in $67 million in revenue with a really strong 26% adjusted EBITDA margin.
So it's very profitable.
Very.
Yeah.
It's built on these decades-long relationships with governments and banks who trust them for secure communications.
And the recurring revenue numbers look pretty stable.
They are. The annual recurring revenue, or ARR, is at $216 million. Now, the dollar-based net retention is at 92%.
Okay, 92%. That's solid, but it's not over 100. It means customers are spending slightly less than they were last year. Is that a concern?
It's a fair question. It shows that, customers are definitely optimizing their IT budgets. But 92% in this environment also shows the foundation is sticking around. They aren't leaving.
So it's a reliable source of cash to fund the QNX sprint.
A very predictable high-margin counterweight. Exactly.
So if the fundamentals are improving this much, why is the stock down 30 or 40% over the past year? There's a real disconnect here.
There is. And that's the opportunity for a contrarian investor. Sentiment is just lagging way behind the reality of the business today.
So what's the valuation look like?
Well, a discounted cash flow model suggests it might be, about 11% undervalued. But the interesting part is the analyst contradiction.
What do you mean?
The overall sentiment from analysts is still cautious, kind of a hold or neutral, but their average 12-month price target is around $4.88.
Which is what, 25 or 26% higher than where it's trading now?
Exactly. So even the cautious analysts see significant upside from here. It suggests limited downside risk with a lot of potential reward.
Okay, but we have to address the elephant in the room, the non-fundamental risks.
We do. There have been multiple reports alleging a, quote, toxic and boys club culture, including some claims leveled against the CEO.
And for investors focused on ESG and just good governance, that's a serious red flag.
It absolutely is. And the company and the CEO deny the claims, but it creates reputational drag. It can affect hiring, partnerships. It's a material risk.
So why is this maybe manageable or perhaps already priced in?
2 reasons, I think. First, it hasn't directly impacted the core technology mode. QNX safety certifications and the government contracts are pretty insulated from internal culture issues.
Okay.
And second, look at how much the stock has already fallen. It's very likely that a huge chunk of that reputational risk is already baked into today's low price.
So if they can show improvement on the governance side, that could actually be a positive catalyst.
We could unlock value, for sure.
So speaking of catalysts, what should we be watching for? The next earnings report is the obvious one, right? End of March.
That's the big near-term one. And the market is going to be watching 2 things like a hawk. First, QNX growth. Can they beat that 10% year-over-year number again?
Just show it wasn't a one-off.
Right. And second, the stability of that secure communications ARR. Just hold the line at that $216 million base. Maybe show some improvement in that net retention number.
Beyond earnings, there's also some more speculative stuff out there.
There is some interesting optionality. The first is M&A. You have 2 very distinct, very valuable businesses under one roof.
You could see a big auto supplier wanting to buy the QNX division outright.
Or a major cybersecurity firm wanting those deep government contracts from the secure communications side. A sum-of-the-parts sale could be worth a lot more than the current stock price.
And the other one is a bit of nostalgia, the brand itself.
Yeah, there's chatter about licensing the BlackBerry brand for a new dumb phone or some other device.
So they wouldn't build it themselves.
No, they're out of that business for good. But they could collect a high-margin royalty check just for the use of the name, which still has a lot of global recognition. It's basically monetizing an asset that's currently valued at 0.
So to wrap this all up, what's the core thesis here?
It's a mispriced, profitable software company. The stock is a contrarian long because sentiment hasn't caught up to the fundamental improvement.
Positive GAAP earnings, record QNX revenue.
All of it. The time horizon here is probably 12 to 24 months, looking for that QNX scaling to really pay off while the secure comms business keeps churning out cash.
So if the company can consistently deliver profitable growth driven by its core QNX business and simultaneously address the skepticism around overall revenue growth and corporate culture, the current depressed price level offers a compelling risk-reward scenario for patient investors.
That wraps up our analysis of BlackBerry for today. Make sure you subscribe, like, and comment below to keep up with all of our stock discussions.